Okay. Peter Rose, Longwood Currency Trading, early April of 2022, and I wanted to chat briefly about the time value of money. I've had some discussions about this topic brought on by my video about why I consider a $3,600 gain to actually be a loss. And the thrust of that was I held the trade for 90 days, and $3,600 is a lot of money. If you divide that by the 90 days of holding period, it reduced the actual percentage gain possible to a very small daily amount. And when you compare what I could do on a daily level with relatively low risk as opposed to the risk over time, then that value was lower. And so that has to do with the time value of money. Let me put up a really rough slide that I sketched out for someone I was talking with the other day. As you can see on the left, we talk about the time value of money being increasing. And on the right, I contrast that with the decay of money over time. They're both very realistic. On the left-hand side, you see that there's an increase. I buy an asset for $1,000. I hold it for a year at 10% growth. I make $1,100. Okay, so you divide the $100 gain by the $1,000. It's 10%. It's a 10% gain. Basically, you can use the rule of 72 on that when you're compounding over time. We do that in real estate all the time, where you say, well, I'm going to get a 10% return a year on my, for example, on my appreciation for the building, and another 10% cash on cash net rental income on that. So I'm getting 20% yearly return on my investment. If I divide 20 into 72, I get the number of years it would take for me to double whatever the investment was that I put in. So that has to do with compounding. So the compounding works in your favor that way in assets that increase in value. If you go to the right-hand side of that chart, you see a decaying asset, and this would be like a currency trade. You have a $1,000 bank, you go in and you get a currency, and you make 10 bucks for the day. So you make a 1% gain. Okay, it's $10 divided by the $1,000 is a 1% gain. If you divide that by the 1 day, then you get 1% return for the period that you held it. However, if you had to hold that for 10 days and made the same $10, then the value of that decayed such that 1% divided by 10 days is 0.1% per day. And so you're looking at a decaying value of that asset over time. It's a lot like if you are conversant in stock options trading and you're looking at the differential between the underlying stock price movement as a function of what that's going to do with the option value. And over time, as the price doesn't get closer to the strike price, the value of that option goes to literally zero because it isn't worth anything. So when we're looking at our returns on our risk and our returns on the time that it took for that return to happen, you have to combine those two things when you're looking at how well you're trading. You can get up at the end of the year and say, oh, I had a $1,000 account and I made $200 that year by trading 42 times or whatever it is that you did. So you made 20%. But if you held that trade for the year, and then you divided that $200 by the number of days of hold, you wouldn't get a 20% average return. You see what I mean? because you can get 10% or 20% in a couple of months of trading, in 3 months of trading. So you divide that, say you divide that 24, gain that you made in the 3 months by 3, and you're getting a higher value on a per unit basis than you would be if you were to just do that once and then have that dissipated out over the course of the year. So there's a very successful trader, and there are others than this particular guy, but he says how he trades is he trades small and he trades a lot. And what he's doing is taking advantage of the law of large numbers. He's trading a tremendous amount of times and making a small amount of money so that he makes a lot of money over a certain period of time. And then that compounds forward very well for him, because if he's trading a lot with a small amount of money, then he doesn't mind, oh, it's going against me, boom, and I'm out. So he's taking an enormous number of small losses, but when he's making the gains, he's making far more of the gains than he is of making the losses. And so those values, the time value of the money is exponential in that case, because he's adding the compounding to it, as opposed to someone who statically takes the $1,000 and drops it in and holds it for a year, and at the end of the year he gets to 20% or whatever. Well, what can you put your money in that you're going to get 20% return a year on, relatively well, management free, I guess. I mean, you get 20% a year on real estate over the long run, but you have all the conditions of management and stuff, and you also have to take the fact that that building value can drop 30% in a crisis situation. So you have to hold over the long term to spread out the average return against the building, and then you're dividing it by the number of years that you had to hold it. You can say, well, I made 20% a year or 10% a year compounded or whatever. I've done that, so I know what I'm talking about. In the same instance, a currency position is self-compounding because of its own momentum, not that you're needing to add more fire to it. If you're trading and combining the momentum move with compounding, then you just light the world on fire. However, because of the leverage that's involved, even though there's great liquidity, you can really get yourself into a jam when you're compounding, unless when you lose, you reverse compound, and then your trading becomes complex. Hey, you might as well do real estate, because the problems are spread out over a longer period of time, so that you can sit there and go, oh shit, this is happening. How am I going to solve that? You do research and you call experts in and you haggle about it and you set up a plan, and then you hire the carpenters to come out and fix it or whatever you need to do. In currency trading, you need to make that decision like right now. Are you going to stay or are you going to get out? Are you going to enter the trade or are you going to sit on your hands? Are you going to enter, and how deep is your stop? All of those complexities and stuff that go into real estate are not there in the currency trading if you make it simple. You don't compound, you trade a lot with a small amount of money, and if your win-to-loss ratio is high, that's the thing that's compounding for you. You don't need to complicate it by compounding yourself, because that works negatively against you. It's very hard when you're day trading in order to make those compounding adjustments. You can compound on a daily basis. Let's say you got $1,000 and you make $10, you got $1,010 going into the next day. So now instead of trading at $1 a lot, you trade at $1.10 a lot, and you build up from there. But you have to trade a lot a day in order to have that take any effect. If you're just going to make one trade a day and compound on a daily basis, you're taking an enormously increased risk because of the compounding, and you could experience quite a severe decay in the underlying value of that amassed asset. In other words, the original asset, the $1,000 bank, plus the money that you had made creating that increase all of a sudden decays by a certain amount, bringing the asset value down, which leaves you less money to try to compound the next time, and you get into all these mental gymnastics and things that are more complicated than you want to do, particularly if you have less than 300 or 400 trades under your belt. It's not so difficult to do compounding when you're a long-term trader, when you're up on the higher charts and you're trading maybe once a week or once every few weeks, because then you've got time to figure all that stuff out. But you're still not really taking advantage of the compounding, because wouldn't you rather compound on a daily day trade type basis as opposed to compounding on a every 3 week basis? You make $400 over the 8 week or 12 week period of time that you held the trade, and you add that into your thing, and so your number of lot size goes up and you compound from there. But it isn't anything like if you trade small with a good win-to-loss ratio, trade small many times and make a decent percentage gain on a daily basis, and then tomorrow compound that. But again, the fact that you've used the momentum of the price itself in order to make more money by trading a lot and taking very short losses and getting out, so that your win-to-loss ratio ends up making 1% a day just on the momentum factor that you're using in your trading. You go into the next day and you do the same thing in straight simple activity. You might have started with $1,000 and you may have $1,500 today to trade, but you still only trade the $1,000 because you're not compounding that. You'd only compound it when your bank got to the point where it was $2,000. And then you'd say, oh, okay, now instead of trading 1 mini, I'm going to trade 2. But I don't think you're going to want to do that on a daily basis. Regardless, if you go into the currency market and you place your trade and you have some profit target that you in no way can control, you may say, oh, I'm going for 200 pips, but you get out at 50 because that's as much as you got out of it. You're not paid for that time. You got paid for 50 pips of profit, but you were holding for that 8 week period of time to make 200. And so now if you divide by the 8 weeks into that profit target, even though you hit it at 50 pips as opposed to 200, you're not getting paid for the risk that you had to put up or for the time that you were involved in. And that's the time value of money in both an appreciating compounding asset like real estate, as opposed to some of the issues that we're faced with as currency traders. Okay. If you have any questions about that, throw it into an email. If you'd like me to do more of this, I can get into a lot more detail on it. But I just wanted to bring that out because I've had some questions about, what do I do here? How do I think about this? And so instead of talking about what you're supposed to do, let's talk about the principle of the time value of money. Yeah? Okay. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.